Beware, controversy ahead. Why ARK Innovation's high-flying returns aren't nearly as impressive as they appear. Are we taking on high-flying ARK, Kathy Woods, Tesla? Oh, man, are we doing this? Yes, we are. Yes, we are. My man Carl had sent this article to me from my man Mark Holbert over at MarketWatch. Man, I've been following Mark Holbert for a long time, man. The Holbert Financial Digest, I think, is where he used to analyze. He might still investment newsletters. Big fan, first time, long time. And Mark, look, and I don't agree with everything he says. In fact, I took him to task in some regard, and he doesn't know me, but he compared the S&P 500 index versus the equal weighted S&P 500, which I think research affiliates, Rob Arnott and those guys do. I'll tell him I can't remember. But anyway, a couple years back, he said, look, S&P 500 has outperformed the equal weighted index, and it likely to continue to do so, even if you look at the aughts, which the equal weighted index started getting its feet because the S&P got smoked. And I agree with Mark's take. I do. The S&P 500 is a momentum-driven index. That's a fact. And there is, I think, a lot of actual evidence that says momentum and trends do outperform, without question. My take on it, though, is the S&P 500 relative to 2000, 2001, and 2 was so heavy in momentum stocks that when those momentum stocks took it on the chin, they fell significantly. I mean, we're talking 50%, roughly 55% down from August of 2000 to March of 2003. Another 50% drawdown from October 2007 to March of 2009. The equal weighted index didn't have that much. And the reason it didn't have as much is because it didn't have that much upside. So as an FYI, I'm not here to sweat Mark Holbert, but I do find this interesting. I haven't even read the article. We're going to read it together. The issue is, and it only makes sense, I know this really ticks off a lot of people, but there is always going to be a Warren Buffett. All right, there will always be, just basic statistical probability. You're always going to have someone that outperforms. And Burt Malkiel over at Princeton, who I think he's still there, who wrote The Random Walk Down Wall Street, there's always going to be a guy who looks like a freaking world beater when it's just luck. You're saying Warren Buffett's lucky? Yeah. Well, and he's had so much accumulated luck. Now he creates his own. I don't deny that. But Peter Lynch, was he lucky or was he good? Did he get out at the right time like a John Elway? Yeah. And now again, that does not discounting what these guys have done. Bill Miller was great until he wasn't. Was that because he was horrible till then? No, it's just he got lucky, man. And even Bill Miller said that as well. So at the end of the day, there's always going to be someone lucky who outperforms, and everyone's like, "Whoa, that's the way to go." And it's just statistics, man. It's just luck. So let's go into this. Why ARK Innovation's red hot returns aren't as impressive as they seem. Statistical scrutiny brings this high-flying ETF down to earth. Yeah, 100% agree. And people get mad when we say, "Well, luck." Luck, man. I'm telling you. Random walk down Wall Street. Luck. You can perform as well as a high-flying ARK Innovation by investing in the NASDAQ 100 index. I know that seems hard to believe, getting this stunning performance that Kathy Wood has produced with ARK Innovation, a 229% gain over the past year. Meanwhile, the Invesco Qs, which is benchmarked to the NASDAQ 100, gained 78%. Since its creation in October 2014, ARK Innovation has produced an annualized gain versus 34.6 versus 20% versus the Qs. All right. Well, you could have performed as well by investing in the NASDAQ 100 index. Well, where's that coming? I don't know. I haven't read it, so we'll find out. At the same time, ARK Innovation has been extremely volatile and risky, making an apples-to-apples comparison with the NASDAQ 100 misleading. As measured by standard deviation and monthly return, ARK Innovation has been 73% more volatile than the Qs. That's really saying something, since the Qs is itself more volatile than the broad market as the S&P 500, which is more volatile, I presume, than the equal weighted index. I don't know that for sure, but I presume it would be. One approach statisticians use to create an apples-to-apples comparison is the metric known as the Sharpe ratio, the 1990 Nobel Prize in Economics. It is the ratio of a fund's average returns to the standard deviation of the returns, and the Sharpe ratio of ARK's innovation since 2014 is almost precisely that of the Qs. If you're like some of my clients, your reaction is not to care about the Sharpe ratio. You can't take the Sharpe ratio to the bank, you'll tell me. It's raw performance that counts, and on the basis, there's no doubt that ARK did better. This reaction is confused, however. If in fact you can take the Sharpe ratio to the bank, if you had been willing to incur the ARK's innovations increased volatility, 73% over the Qs, you could have made just as much money leveraging an investment in the Qs. That is, you could have made just as much by increasing your portfolio allocation to the Qs or by buying it on sufficient margin. This is illustrated in the chart below. Unexceptional RIT on a risk-adjusted basis. So here's the ARK in red. Here's the leveraged Qs. All right, so when you factor in leveraging, you're basically buying it on margin. You could have done just as well as you could have the Qs. The Sharpe ratio is not the only method that statisticians employ for measuring advisor performance on a level playing field, but other widely used approaches reach the same conclusion. Perhaps the best known is the French FAMA factor model, named for the guys at University of Chicago. Okay, their model involves an econometric test. Oh gosh. To see if a mutual fund's return is significantly better than the combination of index funds such as small cap growth and momentum. See, they didn't used to have the momentum. That's what friggin' ticks me off, man. I hate this. They just change it. All these guys change this stuff as the situation turns. The answer for ARK innovation is no. An overweight allocation of small cap growth would produce the same overall return since 2014. I don't know that to be true, but that's what Mark is saying. He's saying if you would have allocated solely to small cap growth, you would have produced the same return as ARK. I don't know that to be true. Luck versus skill. Note carefully that these statistical tests do not prove that ARK innovation performance is due solely to luck. Instead, those tests tell us that we cannot conclude that its performance was not due to luck. In this case, the double negative is not the same as the positive. It's a subtle but important difference. This goes to show just how difficult it is to prove that an investment manager has genuine market-beating ability. If being an index fund by more than 10 percentage points annualized over a 6-year period is not enough, then what is? The answer is satisfying traditional standards of statistical significance requires beating the market by a large amount over a much longer period of time. An example of fund that does jump over this much higher hurdle is the Renaissance Technologies Medallion Fund, a hedge fund that's produced an incredible 39% annualized return over the 33 calendar years through 2020, versus just 11% for the index. Bradford Cornell from USCLA told me in an interview that it's impossible to attribute this fund's outperformance to mere luck. Unfortunately, this fund is only available to current and former partners of Renaissance Technologies because once they get too big, they close. In the meantime, it's too early to render anything close to a final verdict on ARK. Okay, and that wasn't as convincing as I hope it would be. At the end of the day, I agree. There's luck. I'm just telling you right now, man. Look, the random walk down Wall Street means something. It really does. And what we see is what Louis Rukeyser and even the Wall Street Journal. I think Lou had the elves and did he have the monkeys? I know Wall Street Journal. They used to literally have monkeys throwing darts at a stock chart. And whichever did better, that or investment managers, is like 50-50, man. It's nuts. And once you see that, you're like, okay. Now, one of the ways you can reduce your bad luck is not to buy stocks that have no earnings. I'm just telling you right now. That's one of the ways you reduce your bad luck. So the game is to reduce the bad luck to be in position to take advantage of good luck as well, if that makes sense. And which is why I always go back and say, take the gains off the table, you got them, because this can't last. As such, take your gains and put it into something that has had poorer luck over the last few years. Value versus growth. Value has underperformed, starting to turn around now, but it's not too late to take some gains off the table, man. I'm just telling you. All right. Love to hear your comments. We'll see you.